Hello everybody. Hello everyone. Hello everybody, welcome back to my channel. So Not a Guru. It's been a short minute. If you haven't seen my previous video that I just posted, go ahead and check it out. That's my testimony about NACA. Also, I have a lot more videos about home buying in my TikTok channel, so go ahead and check them out and follow me if you're not following me there yet. And also, hold up, don't go yet. If you haven't subscribed to my channel and you don't know who I am, my name is Mireille. I basically just started doing this topic about home buying that everybody's so interested in. On top of home buying, I also do, I document my weight loss journey. I do beauty, and then I also do extreme couponing. So if you also like content like that, appreciate it if you subscribe and join the fam. And also turn on your alert notifications so you can be alerted whenever I post a video. All right, thank you so much. Let's go ahead and get started with this video.
Wait, before we get started, let's powder the face. Okay, ready.
So as you might have read on the title down below, we are going to do a comparison between a NACA loan and a traditional loan. For everybody that is new to the channel and new to my TikTok channel, and you don't know what the NACA program is or what a NACA loan is, I will be making a video in the future talking about it. But just for now, if you want to know more about it, check out the description down below. I will go ahead and post the NACA website. Also, just a quick disclaimer, NACA does not sponsor this video, does not force me to do this, or does not push me to do this. I'm just sharing information. I'm just a person that went through, the NACA program and went through the home buying process and tried it, had a hard time, and I'm just sharing this information. All I'm doing is sharing, guys. Let's go ahead and get started with the fun part. Okay, so to do this loan comparison, we need a household example. We're going to call it the Smith household. So the Smith family, before taxes, they make an income of $5,000. Also, the Smith's family was able to save for a few years, 2 to 3 years. It took them to save $21,000 since they already know that they're going to have to give a down payment, because that's what the traditional banks teach us. You need down payment, you need closing costs, you need to pay for all these things. It's going to be expensive. The Smith family also wants a very nice home, but that it's not gonna hurt their pockets. But we're also gonna make the Smith family not have any debt, no credit card payment debt, no car loan payment debt. And one last thing that we're going to add to this example is, what type of credit score does the Smith family have? Well, for this example, we're just gonna give them a very fair number. Let's say 620 is their credit score. Okay, now that we have the perfect example created, now let's go ahead and see each type, how the Smith family, what kind of loan will the Smith family get if they go through a NACA loan, and what is the outcome or what is the loan that they're going to get if they go the traditional way. So what kind of loan types are offered the traditional way? What will Mr. and Mrs. Smith get? If Mr. and Mrs. Smith go the traditional way, there are several loan types, and this is what I was able to find. So you have FHA loan, you have VA loan, which is for veterans, I believe. There are conventional loans, and I think there's a few more in this example. I'm not really going to go into detail describing each loan. I'll pretty much leave that for a different video. Now, if Mr. and Mrs. Smith were to go through the NACA process, what the NACA program offers is something that looks like a conventional loan, but a conventional loan without any down payment or closing costs. Now, how much is Mr. and Mrs. Smith able to qualify for if they go through the NACA process? What is the maximum monthly payment that the NACA program will approve them for? How the NACA program determines how much you qualify for, you get your household income. So for example, Mr. and Mrs. Smith make a household income of $5,000. You subtract 31% of that. That's the maximum allowed monthly payment that the program will allow you. For this example, I calculated $1,500 as the maximum approved amount for them. Now, how much will they get approved for as a monthly payment if they go the traditional way? Depending on the loan type that they go with, if they go with an FHA program, they can get up to 45%. if they go conventional, and most of the banks will automatically give you 40%. So they're looking at a 40 to 45%. The calculation for that is between $2,000 to $2,250. So as you can see, between both amounts with the NACA program, it's $1,500 to where on the other side you are able to get $500 more. But just because you get $500 more, is it really worth it? Let's find out. So if the Smith family were to go the traditional way, what are the upfront costs that they would need to pay if they wanted to move forward with a traditional loan? On a traditional loan, no matter what, they will always ask you for a down payment. If you go through the FHA program, first time home buyers program, you are able to qualify for a low down payment of 3%. Other conventional loans that you go through directly through your bank, the minimum some will ask for is 5%. So depending which option you use, it varies on the down payment. A down payment for sure is something that you need to count as your upfront cost. Since they're going to go ahead and go the conventional way, they're required to pay 5% down the minimum. And so 5% of $200,000 is $10,000. So $10,000 is what they need for their down payment. Also, Mr. and Mrs. Smith know that they're going to have to pay closing costs. Here are the closing costs for this example. As you can see up here, I did a $200,000 with a down payment of 5%, 30-year fixed interest rate, and this is what comes up. So they're looking about $8,000 in closing costs. Another thing that the traditional bank requires is a private mortgage insurance. As you can see on here on their website, you can see that for every lender, if you do not give a down payment of 20%, you're automatically going to get charged a private mortgage insurance. Don't get me started on private mortgage insurance, but once again, that's a different video. But just a quick info, private mortgage insurance, what it is, it's an insurance for your loan. If you're not able to pay for your loan, there is an insurance out there that the bank can use to protect themselves from falling into losing money, basically, on this property. The private mortgage insurance gets calculated depending on your credit score, on how much your down payment is. You can get from a 0.5% to 1%. In this case, because they were not able to come up with a 20% down payment, and also because they have a fair credit score, they're going to get charged a 1% each month. 1%, I did the calculation on here, it's about $150. This number, once again, it's flexible. It all varies on how much down payment you give, and also it varies on your credit score. Now, what if the Smith family went through the NACA program? What is the NACA program going to offer them? Well, the NACA program right away will not require any down payment. They will not give them a private mortgage insurance, so they don't have to worry about a private mortgage insurance to pay. Really no closing cost, but there are some fees. Doesn't really care about your credit score. They do pull your credit report, and they automatically give you the lowest interest rate in the market. So I know you're going to be asking about what those fees are, and I'm going to go ahead and compare the traditional fees and the NACA fees. It really all depends on the price of your home. Each of these estimates are going to be different. For this example of a home of $200,000, these are approximately the amounts that Mr. and Mrs. Smith will have to pay for. Mr. and Mrs. Smith will have to pay for their own inspection. This can vary between, $250 to $400, $500. It just really depends on your area and what the inspector charges. That is one of the things that you must pay for. You will also need to pay for your earnest money deposit. What is the earnest money deposit? Hey Google, what is earnest money?
According to Wikipedia, an earnest payment is a specific form of security deposit made in some major transactions such as real estate dealings or required by some official procurement processes to demonstrate that the applicant is serious and willing to demonstrate an earnest of good faith about wanting to complete the transaction.
Okay, everything that Google said. Another fee that you're gonna have to pay up front would be your homeowner's insurance. You have to pay for the premium first year in advance. And there will be some other fees here on this side, so go ahead and just look through them. Just give it a minute. But overall, at the end, as you compare it, on one side, on the NACA side, the fees that you're getting charged are going to be way, way lower than if you were to go the traditional way. But at the end of the day, it all just really falls down to your house cost, your earnest money, and it could range between a couple $1,000, $1,000, $2,000, $5,000. I believe mine was $2,400. But like I said, NACA will give you an exact estimate. So there you go, $2,400 or $18,000 to $20,000 in closing costs. Now, how are the banks going to determine which interest rate they're going to give Mr. and Mrs. Smith? If Mr. and Mrs. Smith do go the traditional way, they're automatically going to get judged by their credit score. There's no way the lender is going to avoid that. For this example, I did get to go to several websites. This was the site, Quicken Loans, that I was able to find, the lowest interest rate in the market today. The current interest rate as of today is at 3.375. But the question is, will the Smith family get this interest rate? Because they are going to get judged by their credit score, the bank is not going to take the chance in giving them a low interest rate, and then being at high risk. We're just going to leave it at, a 3.5, or we're just going to leave it at 3.375. Let's say they're lucky enough to get that number. Now, what interest rate will the Smith family get if they do go through the NACA process? Because of the fact that NACA does not judge you by your credit score, every family that goes through the NACA program automatically is given the lowest interest rate in the market. As I looked at the numbers today, I am going to put the website here, but today's interest rate for the NACA program, if you were to close on your contract, if you were to accept your contract today, you will be set to a fixed rate of 3.0. And like I said again, it really does not matter what credit score you have. Everybody automatically gets this low interest rate. But also, one thing that I really love about the NACA program is that it's one of the programs that allows you to buy down your interest rate. 3.0 does not have to be it. You can even get all the way down to a 0.0625%, I think. Compared to the traditional bank, such thing does not exist. NACA gives you the opportunity to participate in what is called a buy down. It's not mandatory, but it is available if you want to get more of a house or a lower monthly payment. Now you're probably asking yourself, how is it that you're able to buy down your interest rate with the NACA program? For this, we're not going to do a traditional loan comparison because the traditional banks do not offer this, but this is how you buy down your interest rate. For this example, we said that the price of their home is $200,000. If you're wanting a 30-year loan, for every 1% that you give for the buy down, buys you a quarter of a point down. So since today's interest rate with the NACA program is at 3.0, the Smith family will need to buy down 8 quarters to bring that 3.0 to a 1.0. So how much money is that? 1% of $2,000 is $2,000. So since we need 8 times 2, 16. $16,000 is what they're going to be needing to buy down their interest. But let's say that, the Smith family wanted to give all their money for the buy down. So remember I said that the Smith family had $21,000 saved. $2,216 approximately will go towards their fees that they had to pay for. The rest, the remaining balance is about $18,800, somewhere around there, ballpark. So $18,800 will approximately get them down to a new interest rate of 0.65. But of course, all of this depends on the Smith family on how much they really want to put towards the buy down, what interest rate they're comfortable with. So now let's go ahead and move to the final step. So the Smith family at this point was able to finally find the house of their dreams. They were able to find a house that was right at their budget at $200,000. Their taxes for this property are going to be a little bit high. They're going to be $350 a month. They called several homeowner insurance companies and they were able to get a low monthly payment of $100. We're going to use these exact same numbers to compare the final monthly payment with a NACA loan and the final payment for a traditional loan. So if the Smith family were to go the traditional way, their monthly payment estimate is around $1,473, and this is going to be the breakdown. So with a traditional loan, the Smith family is approximately going to pay $1,473. I will go ahead and include the breakdown here where I got my calculation, but we're looking at a mortgage payment just alone of $998. Adding the taxes, the HOA fees, insurance, will give you the $1,473. Also, if the Smith family were to want to stay with this home for the 30-year, loan term, what is their interest total that they would be paying for? The interest total that the family would be paying is $112,000. Imagine what you can do with $112,000. It was just money from your pocket that was just given to the lender, because they just lend you, they just approve you for a home. But these are things that, sometimes we do not actually calculate. But, not everybody stays in their home for 30 years. So now let's go ahead and see what the NACA loan will give you. What do those numbers look like? So since the Smith family with the NACA program did not have to give a down payment, so they have that money still available. They also did not have to pay closing costs. They did have to pay some fees, which were $2,216. And then they were not giving a private mortgage insurance. So what were they able to do with this money that they had left over? They decided to spend it all in buying down their interest rate. That gave them a new interest rate of 0.65. So with the NACA program, they're looking at a monthly payment of $1,087. That $1,087, of course, includes their taxes, which are the same, $350 a month. Insurance, that is $100, and this is their homeowner's insurance, not the private mortgage insurance. Homeowner's insurance is $100, and then their HOA fees are still the same, $25 a month. So that comes up to a total of $1,087. Their mortgage part is only going to be $587. So if the Smith family were to say the full term of their loan, how much interest total? What is the interest total that they would have paid? Their total interest paid is $20,187. So as you can see, $20,114. Which one would you go with? So that is the breakdown, guys. NACA loan versus a traditional loan. Of course, on the traditional side, I went like if the score was, almost perfect. Everybody has different, everybody is going to have a different scenario. So just take your scenario that you have right now, take your income, use the same example, this exact same calculation to determine what type of loan you want. So if you can do me a favor, go ahead and leave a comment down below. Which loan should you think the Smith family should go for? What are your suggestions? What are your questions? Anything that you have in mind, please leave a comment down below and I'll greatly appreciate it. So that is all for this video, guys. I don't want to make it longer than it needs to be, but at the end of the day, you decide. What are your goals? What is the thing that's most important to you? Are you just wanting to, get in a house, whatever the rate is, and then get out later? What is it? Or are you thinking of something long-term, something that you're going to stay 10 years, 20 years? It's up to you. What is your goal? The whole purpose of this video is just for me to inform. At the end, it just falls onto you which loan type you would go with. For more content like this, go ahead and subscribe to my channel. If there's something that I missed or something that I said incorrectly, go ahead and correct me. I'm not perfect. I make mistakes, and I know sometimes and a lot of times that I go through my film, I see that I'm like, I should have never said that. But I'm human. Shoot me. Thank you very much for watching. God bless you, and see you on my next video.